Welcome to another edition of Hours and Minutes, where we take hours of information and condense it into just a few palatable minutes. With me today, I have Brant Seigel. Brant is BUI's Director of Advanced Planning and a former private practice attorney. And Brant, it seems like we got a lot to talk about today. So for the last several months, there has been all kinds of speculation in the media about the estate tax. The possibility of the estate tax exemption dropping from the current $23 million per married couple down to $7 million per married couple based upon the proposed legislation from Senator Sanders. Over the last week, there has seemingly been a shift away from the estate tax, and the new target seems to be capital gains. Does this mean that we're out of the woods with the estate tax?
I wouldn't say that we're out of the woods, but interestingly, last week, as President Biden addressed Congress, he did not mention the estate tax. Instead of, when he was talking about how he was going to pay for his infrastructure bill, he talked about the capital gains tax specifically and income taxes, but didn't reference the estate tax. And the thought is that there are senators who would not support the bill, Democratic senators who would not support the bill because they have re-election bids coming up in 2022 and 2024, and they're concerned about how that would be perceived. And that also taking into account that the estate tax exemption, yeah, it may be high right now, but that's only through the end of 2025. January 1st, 2026, we revert back to the prior law, and we're going to have a $5 million exemption index for inflation, so roughly 6.2 to 6.4 million per person. So if the Democrats are going to target specific taxes to increase, well, the estate tax is already going to increase by way of the lower exemptions that are coming in 2026.
So the estate tax is already changing. So they're not wanting to go for that fight because it's already happening. So the shift is to the capital gains, towards long-term capital gains in particular. So let's look at a scenario where you have a $5 million business owner, a business owner that owns a $5 million business. And let's say, look at from a perspective of life and at death. So as it stands today, if that business owner says, let's say, for example, say $1 million basis, sells that business during his lifetime, what happens today versus what is being proposed?
Yeah, so today, as long as he's held the business for at least a year, it would be long-term capital gains rates that he would pay, likely. And just for simplification purposes, there would be a $4 million gain, and he would have to pay 20% tax on that $4 million gain. So, it seems like a hefty tax, but if some of the changes came into play, the first and probably most important one is the max capital gains rate for long-term gains would be 39.6% for those who earn at least $1 million. So it's basically doubling that tax. So you can see it's a heavy hit if this law does indeed change.
Wow. So for the business owner that intends to use that vehicle, that business in a transfer of wealth at death, how does it look today, and how would that look under the proposed law?
Yeah, so today we have stepped up basis, which means if that owner owns the business at his death, then the basis for the heirs will be whatever the date of death value was. So it would step up in your example to $5 million. Therefore, if the heirs went ahead and sold the business the next day for $5 million, there would be no capital gains tax to be paid. We have this legislation pending in the Senate, the STEP Act. And the STEP Act would provide a $1 million exemption for capital gains. Anything over and above that at death would be subject to tax, capital gains tax. So that means, and I'm not saying basis would carry over to the beneficiaries, it's actual tax that has to be paid. So if same business owner passes away with that $4 million gain, well, $1 million of it is going to be protected by the exemption. The additional $3 million would be subject to tax, whether it's the current rate at 20% or if it does go up to 39.6%.
So when you have businesses that are not particularly liquid, or you have a farm that's completely illiquid, how is this tax supposed to be paid?
Yeah, so there is a provision in the bill that would provide for 15 years within which that tax would have to be paid. The first 5 years could be interest-only payments, and then the following 10 would have to be a combination of principal and interest. So they're giving 15 years if the liquidity isn't there, but still, depending on the business, depending on the asset, farmland, whatever it may be, that could be a lot of money that has to be paid, even just the interest payments.
Yeah, that obviously could hurt a lot of businesses and a lot of farms. So aside from business owners and farmers, which are clearly the crosshairs here, what about just the individual investor who's got a portfolio of non-qualified assets, stocks, mutual funds that they intend to use for retirement income? How are those folks essentially impacted by what's been proposed?
Well, first of all, in terms of IRAs and other retirement assets, those would not be part of this capital gains tax change because those assets are not subject to capital gains. But for other taxable assets, investment accounts, stock portfolios, those would be subject to the same rules. So if there are significant gains built in, if a client has a significant position with a certain stock that is low basis, then they are going to suffer the same fate. They've got that $1 million exemption, and the rest of it is going to be subject to tax at death.
Wow. So, and this is assuming that all these, folks can actually prove their basis, which maybe is easy for the investor, but not so easy for the farmers and business owners and everybody else. So,
and keep in mind too, it would be the heirs who would have to prove what the basis is. Not going to be too easy for them. And the Treasury, I can't imagine, is going to have a very easy time pointing to what the basis is either.
Right. Wow. Yeah. So the heirs who have difficult time turning off utilities at death may have an even more difficult time figuring out basis. So, okay. Well, Brian, this has been very helpful. For anyone that has additional questions, please email them to marketing@buiusa.com.